common stock, which gives the owners of those stock the right to elect directors, the right to certain dividends when they're issued, and the right to vote for certain corporate events like an M&A transaction, those types of things. And then preferred shares, which have all the rights of common plus a bunch of extra preferences, hence the name preferred. Now, we're going to move through and talk about those preferences because those are things that are going to be negotiated in here, but they include liquidation preference, right? Who gets paid first at an exit? How much do they get paid at an exit? Special voting rights with respect to director seats. Do they have their own board of directors? They have their own director on the board. Those types of things. So they have these preferences, these extra bells and whistles that get layered on top. And that's what we're talking about when we're talking about selling shares to a venture capital investor. They're looking for preferred stock.
Perfect.
I've done this before.
Okay.
But it can always improve. I think I mentioned fully diluted basis before, and that is a little bit of a term of art. I find, this is something that by and large, I like to sort of think of it as all issued and outstanding common stock and any other security or right that can be issued.
Hello, and welcome to Fireside with VC. My name is Andrew Romans, and today we're with Jason Putnam Gordon, who is a partner at K&L Gates, famous law firm. I believe Bill Gates' father, had a hand in starting a firm that got merged into K&L Gates, hence the name. But today we're taking a deep dive into terms on a term sheet. So this is when you're typically doing a priced round, a Series A. You may have a lot of safes and convertible notes converting into actually issued stock by the company. And Jason's the perfect guy to talk to us about it because he's based in Silicon Valley, San Francisco, where he focuses on both sides of the table, but probably mostly startups, but also investors on everything from angel financings through to late stage seed, Series A, B, C, D, as well as the M&A transactions that happen when the client is acquiring or merging with companies, as well as the definitive exit, paying everybody out, founders and investors in the form of M&A, and then that small window that occasionally opens for very few in an IPO. And so what's really good about this is that he understands what these little terms mean on the final exit and who's getting paid and how much. So, Jason, thanks for joining us. And as a lawyer, I think you wanted to start with a little bit of legalese.
Well, thank you very much for having me, Andrew. It's great to be here today. I appreciate it. Yes. So first, of course, what I talk about today are my personal opinions based in this conversation. They're not reflections of what K&L Gates' opinions are. And of course, what we're talking about today is my sort of off-the-cuff answers to our questions today. It's not legal advice, not legal guidance. If you were to reach out to me, I'm happy to connect with you. Just please don't share any confidential information unless and until you're a client, which would involve a conflicts check. Always happy to provide education and guidance to the ecosystem. Andrew, thank you so much for having me on. Looking forward to today's conversation.
Excellent. So, Jason, before we dive into all these terms, what they mean, which ones are worth fighting for, what's standard, what's happening today compared to yesterday, how things are changing, maybe you guys give advice sometimes on how to even work a fundraising process and get to a term sheet. So what do you tell clients there? How do people even get to a term sheet?
That's a great question, right? So your lawyers are obviously no substitute for your business advisors. Hopefully you've accumulated maybe some of the angels on your cap table, or maybe you've got other folks involved with the business. But certainly what we see when we see clients run a successful process is that they recognize that preferred stock financing, a venture round, is in effect a sale of the company. It's a minority sale of the company, but it's a sales process. And much like in this, many clients, especially if they have a sales background or someone on the team with a sales background, they understand sort of the notion of building a funnel, identifying qualified investors, building relationships before you're going to make an ask, also building rapport and trust in that period of time so that so you can hopefully end up not just with one term sheet, but if all goes well and your company is doing particularly well, a few different term sheets so you can try and drive an optimal outcome for your current investors and for the company in general.
Okay. And And, it's funny, you brought something up I haven't thought about in decades, but I remember when I was an entrepreneur in the 90s and I saw this like $6 million pre-money valuation, or I think it was. And I remember thinking, our company's not worth 6 million. I've already turned down $15 million offer from Telefonica. I could sell this company for a lot more than 6. Why should I even agree to 6? And the venture capitalist said, well, this is not the definitive exit. It's not in that sense the valuation. It's just how do we agree on what percentage of the company do you own and what percentage of the company do we own? So these are really just elements of an algebraic equation, not what I expect you to sell the company for, and that was a little bit of I needed to hear someone say that to me to be like, oh, okay, so this is a good thing,
Well, we certainly see that. So as we think about pre-money valuation or even post-money valuation, especially early stage companies, hopefully they're starting to have some customer traction at this point, starting to get some revenue, but they are far from sort of scaling and peak and being able to use financial models and tools to really sort of price the value of the company. And so while there are some tools and some frameworks that some people will apply to try and value a company, many times it comes down to an algebraic equation. How much of the company are you willing to sell? How much capital do you need to be able to grow and scale to your next milestones? Yes, right. That's what we see for those seed and first round A companies. That's what we'll see.
Sure. So we're going to pull up a term sheet. I think it's an NVCA kind of boilerplate term sheet. I like to think there's a couple of different parts of a term sheet. And, the two most basic ones are there's the financial side of it and there's the governance side. And then there's a whole bunch of other terms that I think it's important for people to understand. And I would also like to say that to entrepreneurs, if you do not understand or are fluent in the language of what these things are, fundraising should be harder for you than if you were. The more fluently you speak this language, the more investors are going to say, this guy, this gal knows how to raise. I don't have to miss Halloween with my kids, which is today is, by the way, Halloween when we're recording this, to educate this entrepreneur on all these things. And as well as with lawyers, I think sometimes you want to impress the lawyers to be able to waive some early, hourly billings while you're raising in the very, very beginning, or even to get them to start giving you advice on how to run the process. So I think it's important for people to understand the things that we're talking about today. So Jason, where do you want to begin?
Well, I think we begin at the beginning if we can, which is, sort of the primary. I agree with you. I sort of generally break this up into economic terms, governance terms. And I think we start at the primary one in part, which is sort of the valuation. That's the primary sort of largest, most impactful term.
Great. Let's dive in.
Yeah. And again, so this is the NVCA form. This one is taken from August 2020. I actually think that within the last few days, they have a new form up there. But this one, we're prepped and primed to move through. And so we're going to go through it today. So if we're thinking about the pre-money valuation of the company, we're thinking about how much is of the company or what it's worth just prior to closing. And the reason why we're focused on that is because we want to understand and identify a per share price for the preferred that's being sold in this particular round. So we identify a pre-money and then we divide that by the fully diluted capitalization of the company immediately prior to closing to get the per share price that the new money is going to pay. Now, I've just hammered in a host of sort of terms in terms of pre-money valuation, fully diluted. And I suspect maybe Andrew's got some follow-up questions and we'll walk through kind of what those things mean.
Well, I think maybe it's worth, some people listening to this or hopefully watching this, since we've got a screen sharing an actual term sheet, is what's the difference between common shares, or in the UK, they would say ORDs or ordinary shares, and preferred shares. So, this document, leading to the definitive agreement will say, or maybe you explain that, who's preferred and who's common? What's the difference?
Yeah. So when we're thinking about ownership of a company, we're thinking about those rights are evidenced by shares in the company. Now, if you've got an LLC or something, that's a whole nother conversation about why it's probably not the right fit or why you may need to convert. But you might be talking about percentages in LLCs. But for corporations here in the United States, we're talking about shares of stock, and those come in basically two forms. common stock, which gives the owners of those stock the right to elect directors, the right to certain dividends when they're issued, and the right to vote for certain corporate events like an M&A transaction, those types of things. And then preferred shares, which have all the rights of common, plus a bunch of extra preferences, hence the name preferred. Now, we're going to move through and talk about those preferences because those are things that are going to be negotiated in here, but they include liquidation preference, right? Who gets paid first at an exit? How much do they get paid at an exit? Special voting rights with respect to director seats. Do they have their own board of directors? Or, excuse me, do they have their own director on the board? Those types of things. So they have these preferences, these extra bells and whistles that get layered on top. And that's what we're talking about when we're talking about selling shares to a venture capital investor. They're looking for preferred stock.
Perfect.
I've done this before, but I can always improve. So, I think I mentioned fully diluted basis before, and that is a little bit of a term of art. I find, this is something that by and large, I like to sort of think of it as all issued and outstanding common stock and any other security or right that can be issued and converted into common stock at one point. So that, or is reserved to be issued or turned into common stock at one point. So that would include other shares of preferred stock. That would include the shares that are reserved for the option pool. That would include convertible notes and safes. And one of the tricky things that I know Andrew is particularly aware of is you don't really know how many shares of stock your safe or convertible note is going to turn into, until you've got a conversion event. You may be able to model it in a pro forma cap table. And a pro forma cap table is that. It's a model based on a number of assumptions. Maybe that assumption is on this term sheet, but you don't know what those safes or convertible notes are going to turn into. So things that go into
another one.
Yeah. Go ahead.
Another one, Jason, to not leave out. I think it's on a fully diluted basis. We're talking about all issued and outstanding stock. And then we're also talking about, in addition to safes and convertible notes, of the ESOP, so employee stock option pool, which you talked about, right? And that's a percentage of the company. And sometimes a dirty trick that gets dropped on your head after. And so the denominator gets a little bigger with a fully diluted basis bit than you thought. And so your numerator, how much you invested or how much you even owned as the founder or existing incumbent investor, your fractional ownership goes down because the numerator is how much you had, and that's number of shares. Denominator gets bigger, but there's also warrants. So essentially options for people that don't work at the company. So there might be some advisors that people aren't really seeing in the conference room that had, oh my God, you gave him how much? And he has the right to buy stock. He's not an employee, so it's not coming out of the ESOP, but these are warrants. So I kind of think that that's what fully diluted is talking about.
That's right. Warrants are basically kind of options, and you can also see them issued to like your landlord, to the landlord of the company, or if there's, a venture debt facility, sometimes we'll see warrants in those capacities.
Yeah, loan kickers, yeah.
All of those. But that's one thing, but the sort of one sort of nuance that sometimes entrepreneurs and others in the space aren't familiar with is like fully diluted basis is different than what the number of shares are that are authorized in the charter. Now, if you file your certificate of incorporation, there'll be a certain number of shares that are authorized, and you can't exceed that without amending the charter. But when we're thinking about fully diluted basis, we're not including any of those authorized but not issued or not otherwise contracted for shares. So people get very confused about that, and it's not included in that denominator. So with the sort of basis of understanding why we're trying to understand the pre-money valuation, why we're trying to find the fully diluted basis, sort of that sets the per share price that the new money is going to pay. And then once that new money comes in, you take the pre-money valuation, you add the money to it, and then you got the post-money valuation of the company. So that's kind of how you square that circle and get that algebraic math working out and working together. I think that's one thing that folks should pay attention to and understand. This money is really just pre-money plus the new money
of the investment round. And how are safes and convertible notes treated in this equation?
So the new money, so like the newest investors who are coming to the table, those investors who have given you this term sheet are almost always going to want to have their fully diluted basis include everybody up until when they come in, right? And we can kind of see that in some of the language here in the pre-money valuation. Shall be determined on the fully diluted basis, which pre-money valuation shall include all unallocated and uncommitted option pool. And many times we'll also insert, safes and convertible notes having converted in there. So that's where you typically sort of see that in there. Now, with respect to converting those safes and convertible notes, you got to read those really carefully, because sometimes, especially if you've done safes and convertible notes, you're going to end up with some contradictions, and both the math can be difficult to solve, although thank you Excel for iterative calcs when you need to iterative calculations when you need to be able to kind of solve circular references, or you're going to need folks to come together and agree, yes, at the end of the day, we're willing to accept this, because again, you can end up with these internal inconsistencies in there.
Yeah.
And that, those Excel sheets can lead to a big headache. So,
yeah.
And they're also really critical, because at the end of the day, folks are really interested in buying a percentage of the company. So, getting the math right is critical, absolutely critical.
Right. And so what are we on to next? Dividends?
Yeah, I think so. So, dividends, I can't say for an early stage round. So we're talking really about your first round of institutional venture capital investment in the company, right? At this point, they're most common that we would see is when and if declared, dividends will get paid. And maybe there's a specific percentage that is attributed. And, I will tell you, the market has kind of changed a little bit. It used to be, on the lower 4 to 6 side. Now it's maybe more sort of 6 to 8 that we're seeing now. But that's often not very heavily negotiated, because sort of big picture, most of these venture investors who are investing, and obviously, Andrew, you can speak to this more authentically than I can, but they understand it is a relatively long-term play. It's a 5-year, 7-year investment. By and large, they're going to be invested kind of along with the founders. They're going to have the same sort of exit horizon as the founders, and nobody's really going to be expecting to pull cash out of the company until the sale of the company. And so, usually dividends are not going to be too highly negotiated in this initial round. The other flavor that you need to, pay attention to is if there's a cumulative dividend, and if it's accruing, which basically it's almost like, and it could actually end up getting treated from an accounting perspective like debt. It's almost like interest that sort of keeps accruing until the exit. And then it's not just the percentage ownership or the number of shares that the venture capitalist would have, but also the sort of accrued cumulative dividend kind of weighs in there too. And they get to extract that in the liquidation as well. But those are not particularly common. I'm not seeing those very often these days for sort of first round of investment in companies.
So in my experience, dividends were, when I was an entrepreneur in the 90s, dividends were there. Like, maybe it wasn't so founder friendly. The investors had more power. I don't know. You had dividends. When did you see dividends disappear, and when did you see dividends reappear in your dealings?
Well, I'm not saying no dividends. I mean, usually we just see sort of like dividend of 6% if and when declared by the board, not these accumulating dividends, right? Which basically is like, we're going to get 6% every year and it's going to just accrue. That's what I'm saying. We're not seeing a lot of that. Did you see more of that kind of in the 90s? Or
Yeah. I mean, so my experience, and I only know this because it happened to me, right? Is that your investors invest, let's say for incredibly simple math, $100, and of course it's millions of dollars, but they invest $100, they buy X percentage of the company, and then they have participating preferred, perhaps, liquidation preferences. And so on the day that the company is sold for $100 million of cash, and they own, at this point, 30% of the company, they get $30 million. But wait, they get more, I get less, because they say, I put in $5 million, 9 years ago. And after 1 year, we had an, 8% on top of it. So if it was $100 investment, they now get $108 out of the exit as if it was a 1x liquidation preference, they get $108 back, and then it's pari passu. They get their 30%, we get our 70%. But those things were accruing. And so every year, we were basically giving them 8% of their investment into an accounting an accounting, cell that would tell us how much they actually get. So it was a backdoor way of lifting the liquidation preference. And the average civilian hears the word dividend and say, "Oh, Bill Gates, Bill Gates Senior's son is paying a dividend to Microsoft shareholders, and there's this cash going out." But I've never seen that happen.
No, I mean it's almost kind of like a convertible note, right? That interest rate, it just keeps accruing.
I think the first time I heard someone explain the interest rate on a convertible note to me, I thought, it makes sense. We're rewarding the investor for being in there longer before the conversion. Like if I invest today and then tomorrow benchmark does the price round and I convert, hey, I'm happy I got my, 500K in there. But if a year goes by, then there's, my 500K plus 6% of that as a dollar amount to convert. So I kind of think it's like a mirror. If you're on the note, you're doing convertible notes, you're getting that 6%. And once you get into priced rounds, the interest rate is now a dividend. But it is very different because, they're just saying how much of the liquidation cash payment is before it goes pari passu in a participating preferred. Whereas in the interest rate on the convertible note, that's determining the dollar amount to buy shares at that pre-money valuation that probably has a discount or a cap.
Well, I mean,
different.
You get liquid on the dividend. You don't get liquid on the convertible note. And then, of course, most of these convertible notes are converting into shadow series. Like in the past, they didn't convert into shadow series, and so there was no liquidation adjustment to them. So that you could argue maybe like you kind of would get that bump up if the company turned around and sold the next day. But we do see these. I mean, these are not unheard of or never existing. It's just usually they're sort of for later stage companies and or companies that maybe have raised before and are having a little bit of trouble raising at this point, right? This is another way to sort of juice the return for that investor who's maybe taking a little bit more risk sort of at a later stage. Yeah.
I would say, even on the later stage, it also serves to kind of light a match from the investors kind of lighting a match under the founder saying, "Hey buddy, don't turn this into a lifestyle business because the longer you wait, the more my family's loving it. So bring this thing to an exit so I can go out and raise my next fund." So I think it serves a slight bit of that function. But so we've been talking a lot about liquidation preferences without defining them.
Oh, yeah, fair enough.
Take a go at that, the next one.
Yeah, thank you. Yeah, so we're sticking with the theme at the moment for economic terms, right? And economic drivers. We hit valuation, we hit dividends, liquidation preference. That's basically who gets paid first on an exit when there's a liquidity event, basically, cash coming in or cash being distributed to the owners of the company. That's where we talk about liquidity. So, it can be, you said pari passu. That means basically it's like Latin for all on the same footing. Everybody sort of gets treated equally in that circumstance versus senior, which would be those people would, get paid first. And you can have different levels of seniority. Maybe this in it, it's an accounting sort of last in, first out type things. The C's will get, if there is a seniority stack, right? Maybe that seniority stack is D's get paid first, then C's, then B's, and then maybe folks in the seed and the A or pari passu at that point too. So,
and I think it's key. I think it's worth stating that if you have like all the angels, the Series A, the Series B, the Series C all get funded, and they're all in the same liquidation preference together, and then some big crossover late stage super growth fund says, if I can tell my guys that I get paid 100% out before any of you guys, like you've invested 150 million, I'm just putting in 50 million now, and I get my 50 million safely out before any of y'all get paid, and the company's got this much revenue, so any low case multiple on it is that the company is easily going to be sold for more than my 1x liquidation preference. I can talk my board of directors at Bank of Boring with no risk takers that this is a risk-free investment with some upside, And so therefore, who cares what the valuation is? So you could have a higher valuation come up if you're more generous in giving someone a senior liquidation preference. And, some of those VCs and founders might be happy with the markup and happy to see, yeah, of course he gets his money back 1x. There's no way in hell this company is going to exit for less than that. Or we're heading to IPO. It's all going to convert to common anyway. So who cares? But anyway, I thought I'd throw in a little bit of my view.
No, I think that's great.
That's
great. I would just add like relatively risk-free. Like none of these investments are risk-free. I mean, just because
nothing.
I don't know who's
I think I
going to be
said
listening
perceived,
to us, but
I used the word perceived risk-free.
Got it. Okay.
That's my legal disclaimer. I've learned how to speak that way.
Got it. But that's right. So hopefully folks now understand what the concept of what a liquidation preference is, and they come in a number of different flavors, right? So usually in the earlier stage, we'll see, sticking with the theme that your first investors usually have a relatively long time horizon of investment aligned with the founder, 5 years, 7 years or so, depending on the business, maybe a little bit longer in the sort of the life sciences space. What we're typically seeing is 1x liquidation preference, which means that they get the greater of either their money back, or if they converted to common and got to play along with the common holders. And now there are other flavors of that. It doesn't have to be 1x, could be 2x, could be 3x. I don't see that quite as much early stage, but a little bit later. And then whether or not they're participating. The other sort of flavor that we see is like participation, which may mean, they first get to have their liquidation preference, and then they participate or pick up or act as if they had converted into common and pick up sort of the remainder as if they were common. And then even that can be capped. And so, yeah, go ahead.
I just want to make sure it's clear that when you said the greater of converting in, that means they get paid their ownership percentage. So if they had a non-participating preferred liquidation preference of 1x, and they own 30% of the company, and 30% of the company is 10x the cost of what they put in, then they just get their 30%. The founders get their 70% of the entire exit consideration, right? Whereas if they had so that's what conversion meant, that it's either get your money back 1x, or maybe it was written down as a 3x, or the greater of, it was a bigger number to get I own 20% of the company or 30% of the company. That's more money than getting my money back 1x or 3x. That's correct. Yeah.
That's right. Right. The sort of nuance there on the M&A nuance is like, even if the company's valued at $100 million, obviously there, sometimes there's escrow holdbacks, and there are other things too that sort of impact your take home. If you have 30%, you might not walk away with 30 million. It might be 25 million or 27 million by the time you've, sort of paid off any liabilities. Like, let's just say there was a line of credit that was open that needed to get paid out of the proceeds, or those types of things. But back of the envelope math, you got to pay the lawyers. Yeah. It's always nice to get paid on closing.
I think it's IRS first and lawyers second, almost, right?
Yeah, I think that's right. It's always nice to get paid on closing too. So we're always appreciative of that. So this can be modeled, but typically folks in the early stage don't necessarily spend a lot of time modeling this out, as opposed to sort of running that pro forma for ownership, as we sort of discussed earlier, in terms of like percentage that the preferred is going to get. And that's, related to the pre-money versus the amount of the investment in the post-money. Should we move on to voting rights, Andrew, or did you?
Yeah, I would just say that, I'm just speaking out to the founder who's never gone through this before. The first time I heard this, I said, yeah, these guys are like mafia putting in horrible things on me, like vulture capitalists, please. And then someone explained to me that, look, if I invest $1 million to buy 20% of the company, or and you turn around the next day and sell it for $500,000, I want to make sure that, that doesn't happen. So the fact that I get my money back next, I feel protected, that I don't need control of the board of directors. And now we're switching into voting rights. So I kind of thought there's some logic to that. And it's not mafia, vulture capitalism. It makes sense.
Yeah, no. So we have that conversation kind of all the time. And this goes maybe with the pre-raise considerations we were talking about. It's like, understands kind of where your company is in its life cycle. Is it a company that is appropriate for venture investment, right? Is it going to have an exit in 7 years? Is it going to be multiples, right? I don't know what you look for, but it could be 10, it could be 30, could be 100. Venture capitalists have a job. They've got investors in their fund. Their investors have expectations. And so, they're deploying a strategy, a high risk, high reward portfolio approach to making an investment. And so, they're looking for companies that are going to fit that model. They're going to need to, try and mitigate or moderate some of the risk. And that's kind of where some of these governance and other prospects come out, right? So the economic terms kind of go with, Are you the kind of investment that's going to be what's necessary to basically return the fund for the VC? And then these other provisions are, ways to try and mitigate risk, especially because, many times they're investing in unproven entrepreneurs, right? First round investment, sure, you've gotten this far. You've got a team, you've got a prototype, you've got initial customers, right? That's a demonstration that you can go to market, but you haven't scaled a company. And so lots of VCs have a lot of experience doing that, right? They have a lot of previously successful entrepreneurs who are in the funds, like yourself, Andrew.
Well, there's psychology to how you're communicating with a VC during a negotiation. The founder is really freaked out that we're investing $1 million and on a pre-money valuation of, say, $10 million. And the founder is now freaking out that if the company is sold for 1 million and a penny, we get all the money with our 1x liquidation preference. Does that mean the founder is expressing genuine concern that the company is going to be sold for less than the pre-money valuation? Because like you said, we're going for power law of return the whole fund with one investment. We need a few of those in the portfolio. So you don't want to expose that you're legitimately worried as the founder that this 1x liquidation preference is going to be the end of days.
It's kind of sticking with the sales process theme, right? It's like, you got to know your audience, right? And then, once you're comfortable with them, you understand how they work and operate, then everybody can kind of come together and, hopefully start making successful transactions and deals together. Voting rights are sort of one way to help mitigate some risk, help get the investors comfortable, right? And so usually the preferred stock are going to get to vote along with the common on, any corporate issue that's going to come up. And so as we sort of think about the way the VC model works, entrepreneurs don't get all the money that they need to scale the business up front. They get what they need to kind of get to their next, they build out a bunch of milestones over a number of times, anticipating a number of raises, a number of fundings. That helps the investors mitigate risk to a certain extent. And as a natural result of that, there's going to be anticipated dilution, right? And dilution is not always a bad thing. If you've got a, relatively speaking, smaller slice of a pie that is a lot larger, you're wealthier. You're doing much better. That's the name of the game. And with that in mind, as you sort of think about voting and shares of stock, yes, the preferred usually get to vote along with the common on any number of issues. And then they get other rights, like being able to elect members of the board. And board composition is very important and very highly negotiated in a term sheet, both with respect to who's on the board and who's going to be an observer to the board potentially, and what information rights are sort of associated with that. So some things that we often think about when we're talking about, well, even as early as setting up the company, is board composition, right? It's harder to pull people off or out of a position than it is to put them into a position, right? So if you were a company and you had 5 founders, probably is going to give first of all, statistically, at least 1 or 2 are going to leave by the time you get a venture capital financing. It takes usually 2 or 3 years to get to an institutional round if you are a company, even if you are a successful company. That's just sort of what the odds sort of bear out. Secondly, if you've got 5 founders on the board, that's already a big board. And by the time you get to a venture rounds, you're not going to want to have a board of 5 founders plus a venture investor or 2 venture investors. It's too big. So you're going to need to have some folks come off of that. It'd be difficult to start pulling founders off. So better to think early and sort of make the hard decision early when it's less painful. That is, don't put people on the board that you're going to have to pull off.
Yep, sounds like good advice. And what is your advice on how many directors on the board, when there's a real price round happening?
Yeah. So,
and I know you do a lot of drug discovery biotech where the boards get out of control completely, right? Like those things are just complete zoos, from my experience. I haven't looked at any of them in a long time, but in my ancient history of dealing with it.
Yes.
What do you recommend for the right number of people on a board?
I mean, first of all, odd number, right? Which you don't want is deadlock. So deadlock is where each director or each even number of director has a different idea about what they want to do and go, and then the company is basically stuck, and then you either need to go to court or you need to get a director off, or it's kind of a nightmare. So then we're
precious. That is precious advice, because I've actually seen even number boards and said, guys, you got to stop this immediately. Appoint a mutually agreed to person, or somebody gets 2 votes. And then 6 months later, they still haven't done it. And I'm like, Jesus. So I think that's incredibly valuable advice. It's got to be an odd number.
Right. Or at the very least, even if it's an odd number, but you've got an even number, but you've got one vacancy. So you've got an even, if there's a mechanism by which you can then, without much stress or heartburn or difficulty, get an odd number, then you can more easily get through a deadlock. So that number has got to be odd, which means like an early stage company, VC funding, that's usually either one, which I'm honestly always kind of a decent fan on. It depends on like the circumstances and who the founders are and what their relative strengths are, but either 1 or 3. And if it is 3, then you need to think about, well, when you get to that round, likely, not always, but likely there's going to be an investor who's going to want to have at least, have a board seat on there. And so who's going to come off of that? So, if it were like a series seed round, I'd love to see sort of a board of 3, but, certainly no more than 5. And if it is 5, maybe it's sort of like 5 with a vacancy or 2. And, I think one thing that companies should be mindful of, and this is sort of, again, general guidance, every situation is different, is the observers. The observers, even though they may not have a vote, can be very powerful and persuasive. And that can, that can hopefully be a good thing. But there can also be some groupthink and other things that sort of like happen on a board, whether you have a small size or a large size too. So just being thoughtful about who's going to be in that room when the decisions are being made. And then, of course, even if someone doesn't have an observer seat, even if an investor doesn't have an observer seat, just good investor relations may sort of call for, if you've got some sort of significant or impactful investor, having them come in and observe, or having a representative there. You're shaking your head yes, Andrew.
Yeah, absolutely. I disagree with everything you're saying. I like a board of 3 until you've gotten to like a real venture investor that is hopefully a force for good for your company. And I think it's quite common in my experience that when you're doing a Series A these days, which is almost what like a Series B was in the 90s, that there's like 2 people from the company. One should be the CEO. So it should be like two co-founders perhaps, or the single founder who's the CEO, and someone else from the team that is considered loyal, like a CFO or something, so head of sales. And then so that's 2 there, and then 2 from the money. So like Benchmark Capital wants 2 board seats. They think they're pretty valuable, so they want to be there. And then 1 mutually agreed to person to get us to 5. And my advice to everybody on all sides is always be gunning for that mutually agreed to person from your network. So like we often have an LP take that, like we've always got a valuable LP somewhere that would be a great board member. And so we might, and they shouldn't join the board unless the founders don't fall in love with that person. So that's what I think. I think 2 founders, two investors, and 1 mutually agreed to person. And if you go through another big funding and like NEA comes in, they may want to join the board and someone's willing to leave the board. I'm always very happy to get off the board in these cases.
Well, so that's a great point. I think that is a very common framework. It works well. And I sort of even think, as you're sort of talking about, not all investors want to be on the board throughout the entire life cycle of the company, right? And so having these conversations about what happens at the next round, so that, if you're at the A or the B, you don't have a board of 9. Like, I think that probably in most circumstances would not be so palatable. So just kind of thinking, obviously you got to get through today to get to tomorrow, but also be mindful of what tomorrow will be and sort of how you'll handle it and sort of socialize these issues, I think is very helpful. So that's great. I don't have much else to add to that, Andrew.
Okay, great. Let's keep powering through this term sheet.
All right. So next are protective provisions, also sort of governance related issues that appear in the certificate of incorporation, the amended and restated certificate of incorporation. And the certificate of incorporation is sort of like the constitution of the company, right? This gets filed with the state of Delaware to, especially here in the US, we're almost always talking about Delaware companies. And what these protective provisions are primarily about are sort of protecting like the economic interests of the investors. You can't mess with their shares of stock, right? You can't change their preferences without their approval. You can't waive their liquidation preferences. You can't sell the company without them having the opportunity to vote in favor or against that, preventing significant dilution by monkeying with the option plan or, and increasing it sort of significantly and granting it to founders or other folks in the company, those types of issues. That's what we typically will see in the protective provisions. They are not typically, although sometimes you'll see some of these things in there, but they're not typically related to sort of day-to-day governance or business issues. So again, things that sort of would alter or repeal the charter or impact the preferences of the securities or create a new security that would be senior to, another layer of preferred stock that would be senior to the preferred stock. And early in the company's life, it's usually sort of with respect to the class of preferred as a whole, as opposed to series. But sometimes as you've gone through successive rounds of financing, each series may pick up sort of a limited number of special protective provisions with respect to it only. Does that make sense, Andrew?
Yeah. And I think part of what is happening here is that the investor is buying a minority of the company. The investor has, 1 out of 3 board seats in that, or 2 out of 5. So they don't have control of the company. And yet, if the company wants to go and raise more capital, things that really impact them, they actually, can stop it from happening. If the company, says that we want to do a initial coin offering or, security token offering, they all of a sudden discovered, gee, I thought I had more than 50% of the voting rights of my business. And in fact, these conservative guys are not letting me do a token offering in Thailand.
Right, which could be very impactful to the investor's investment, right? Just as an exit would be impactful too. So that's why we'll also see things like exclusive licenses, for example, entering into an exclusive license of the company. That'd be usually baked into sort of the definition of a deemed liquidation event. But again, sort of approval of those types of issues, things that would lock in the return for the investor or materially impact it, get protected in here.
Mm-hmm.
I'm trying not to drive too much into the legalese, but it's a little hard sometimes, Andrew.
No, this is perfect because we're going just deep enough, not too deep.
Got it. So we would see that there. Another feature of preferred stock is its ability to convert into common. So, one might ask, at its own option, right? So, there could be situations, whether that's an exit that you'd want to convert into common, or maybe you want to convert into common because there's a vote that only common can participate in, right? Maybe it's for electing the directors to the common or something along those lines. We'll sometimes see that get exercised as well. But we see that in the optional conversion. That's usually very common. It's not really highly negotiated at all in the term sheet. And then another economic term or protection is the anti-dilution provision. So what I think is overwhelmingly market these days is sort of a broad-based weighted average. And what that means and what the context is if there's a down round, the investor doesn't want to get diluted. If there's a down round in the A, the Series C investor doesn't want to be overly diluted, right? So there are a couple of ways to deal with this. They could either get sort of topped up, and by topped up, I really mean the conversion ratio of converting their preferred into common changes. They don't actually get more preferred, but if they were to convert into common, they would get more common. It wouldn't be 1-to-1 anymore. You either get topped up on sort of a 1-to-1 basis, which would be like a full ratchet, as if their shares have been issued at that new price. But we don't really see that. We see a broad-based weighted average as being sort of overwhelmingly market these days. And that basically just means we take a look at what the price is that you're selling those new shares for. We take a look at how many are getting sold, and we sort of average it. And we end up kind of in between what we paid and what the new money paid. Not highly negotiated at this point, but obviously common and to have it in the term sheet.
Mm-hmm.
Mandatory conversion are the situations in which the preferred is going to be forced to convert into common. Now, they can happen on good things, right? Like an IPO. You're going to want to have all those. You're not going to want to have, and the investors themselves won't want to have preferred stock if and when there's an IPO. They're going to have common stock, right? But you want to have a mechanism to basically make all of the preferred become common. And so we typically see that in the IPO. And then we also see a mechanism, that if you've got a certain number, which is typically, at least initially, maybe the holders of a majority of the shares of stock that are the preferred stock that are outstanding, can force all the other preferred stock to become common stock. And this does get negotiated. And this gets negotiated because if you become common stock, you lose the things that you had as preferred stock. You lose that liquidation preference. You lose those protective provisions. You may not have that. You probably won't have that director seat anymore. And there can be times when it is appropriate to have all of the shares of preferred stock be converted to common stock, right? If the company is doing really poorly and needs to get a recap, maybe that's the only way it sort of survives. But nobody wants, but it is not to be done or exercised sort of without caution and without it being an appropriate situation. And so investors are paying attention to this, and this does get negotiated.
Mm-hmm. Yeah, and I think it's always very exciting when you see a company truly going for IPO, and just the knowledge that a monster-sized liquidation stack is going to disappear, which has been hanging over the founders, can't fall asleep without headphones on for years. And then boom, all that preferred just becomes common. I think it's exciting.
Oh yeah. No. I mean, it is definitely worth opening a really good bottle of champagne over for a host of reasons. Okay. So yeah. And so, that's kind of the skinny on the mandatory conversion. On the pay to play, which is sort of an optional in here, we don't really see that very often. I'm not sure I've ever seen that in a sort of initial financing. That's basically sort of like a cudgel that if an investor doesn't participate in the next round, something bad's going to happen to their shares. Maybe some of it or all of it will get converted into common stock or
Jesus.
And yeah.
Yeah, that's terrible. I mean, if maybe the guy only does seed investing, he only invests in pre-product, pre-revenue companies, he's guaranteed to own nothing, right?
Well, they'll own common, but they're going to lose their preferred rights. Yeah.
Okay.
Yeah, if they don't continue to participate. So, we would see this more frequently kind of in a later stage round, especially if the company has had a difficult time raising capital, maybe it gets put in there.
Pay to play provisions have a place in the world, not in the beginning when everything is honeymoon roses.
Yeah. Right. Yes, that's right. That's right. I mean, if the term sheet has a pay to play, you should definitely make sure, and it's your initial financing, you should definitely make sure. I mean, you should always have counsel, but you really need to have counsel. That might not be the right one for you. Who knows? Redemption rights also not very, we just basically don't really see it sort of early stage. Later stage, it makes more sense. It's the ability for the preferred investors to have the company redeem or buy back their shares. It's sort of a way to be a little bit of a stick, maybe, to kind of like, hurry up, let's get to an exit, guys. Otherwise, or if you've got a fund, but funds have a certain life cycle, and they need to be able to wind up, if they're sort of investing maybe on the later end and it's a later stage company, they want to have an ability to get some liquidity on that investment. But we wouldn't typically see redemption rights in an early stage company.
I had redemption rights of 8 years in my first term sheet I signed in the 90s. And by the time I got to that part of the term sheet, I said, I don't know, it was like 2 a.m. I was like, all right, I'm just gonna put this down. I'm not gonna email anybody. I'm just gonna calm down. This is insane. Because I was getting upset. I was like, what? Now they're saying that after a couple of years, if they put in the 15 million now, and I've got like 5 million in the bank and I'm burning through it, they can demand I pay back the entire 15 million, which the whole idea is you're getting an ownership of the company so that I can build it faster or build these products that, there's no way to build like semiconductors or whatever without doing that. And the notion that they could just, after a certain date, it's like the maturity date on a convertible note. They could just ask for it back and redeem, like this is a hedge fund,
right. And like you're going to have the liquidity to be able to do that. I mean, that's sort of
so it's just giving them a stick to drop the dynamite and explode the whole company is kind of what it felt like. I could see how redemption makes sense where you're trying to invest in companies that are going to exit within a 1 to 3 year time horizon, and you put 5 years in there of saying, come on, we're Summit partners. We literally invest right before a liquidity event. That's what we do.
Right. If you're afraid of this is a tell for us that, we don't actually have the same alignment and horizon.
Yeah. So I can see redemption making sense in a world of we're pre-IPO, invest before an exit type guys. For us with such a long-term horizon of, a bit of seed, a lot of late seed, and a lot of Series A and some B, we want to message to the founder that we're with you for a long march.
No, that makes sense to me. And actually, I want to, if I can, I'd highlight. I think what you did in terms of sleeping on it, putting it down, was good. That was like a good decision-making process. To the extent it's difficult, I think, if you've got a term sheet or two to, let the adrenaline kind of cool. But, I feel like some of my clients have sort of always made their best decisions if they've sort of done the work that they needed to do and then let it sit. And, then they get very comfortable with it. So I don't know.
Or talk to guys like you that say, hey, this was really common in the 90s, but I haven't seen a 5x liquidation preference in quite a while. Where do these people live? What part of the country are they from? Like what that's very non-standard. So you've said during this episode, you're just like, that's standard, like standard, like this is like, or you said market, you said this is market. And there's a market, just like there's a price of gold, of demand and supply and demand of what's the price of gold. There's sort of a market of what is tolerated in Silicon Valley and different ecosystems and what's market. If the stock market crashes, things might change of what is market.
That's true. And because we are a global law firm, I do have the pleasure and privilege of working on deals from all over the world, all over the US and then all over the world. And what is market in Silicon Valley is different than, sort of what's market in New York or Boston versus what's in Texas versus Australia. And so I think being able to get local intel on those practices, especially with respect to kind of what investors' expectations are, is very important and very helpful.
Yeah. Yep.
So should we move to the stock purchase agreement? Are we still good?
Yeah.
All right. Stock purchase agreement is really just basically sort of the mechanics. There's two important components, kind of like the mechanics of like, how are you going to get this deal done? What's the closing going to look like? Is it going to be just one close, or is it going to have an opportunity to have multiple closes over a period of time? I usually like to at least see some, to have the ability to have more than one closing, because, especially if there's like a syndicate and, who knows, maybe there's some angels. If you've got angels that need to convert over, or they're putting in additional capital, best not to let everything hang up for just one investor who, is having trouble getting the wire out. Better to be able to kind of bring them in the next day or week or whatever it is to get that deal closed. The other really important component for companies that we see in there are what's called representations and warranties. And these integrate with the disclosure schedule. So representations and warranties are basically statements of fact. When you read them on their face, they need to be true. If they're not true, you either need to, change the rep so that it's true, or you need to disclose some piece of information so that when you read the representation and you read the you read the disclosure schedule, it's true. So an example might be something along the lines of, we are registered and qualified to do business in all the jurisdictions where failing to do so would have a materially adverse effect on the company, right? Just trying to drive that down into plain speak. We've registered with each of the states and where, we basically need to get registered, right? And one of the criteria is usually like, where's your workforce, right? So let's just say you're out here in California, but you only have a Delaware corporation and you haven't qualified. You haven't gone to California's Secretary of State and qualified as a foreign corporation. You haven't registered with the FTB, right? There are a few things you can do. One, you should probably think about qualifying in California if you've got, your staff out here. You'll probably want to disclose that to the investor anyway. But if for some reason, whether it's here or somewhere else, and you weren't in a position to qualify someplace, and maybe you didn't think it would have a material adverse impact on the business, right? But you were just a little concerned, and it's better to sort of usually over disclose than under disclose. You probably put that in the disclosure schedule, right? We plan to, right after closing, register in North Dakota because we have a sales consultant there or something, something along those lines. Of course, I would always advise qualify as soon as you can, but that doesn't always happen.
Okay.
But that's what the reps and the warranties are. They're really important. The investors pay a lot of attention to them because it helps them with their risk assessment, right? And especially like their legal counsel as they go through it. They think, oh, this person has like a SaaS company. They're selling all over the United States and they've never collected sales tax. That's a potential liability. What are we going to do about that? And especially if you're an early stage company, and I'll let you weigh in on this, Andrew, nobody expects these companies to be perfect, but they do expect, it's a long-term partnership. So you got to be open and honest with your partner, and you got to figure out how you're going to work with your partner kind of moving forward. And so these disclosure schedules can be helpful and a good tool, or at least the exercise can be a good tool to address these issues and make sure you're on board and on the same page with your investor.
I completely agree. And I've seen deals where the deeper you look, the more there's some very concerning problems. And then we agree on a service provider that we've known for 15 years to come in and forensically sort some things out right afterwards. So that, you kind of reveal, we need to get our house in order, and we know people that can clean it up. We have a sense of, how long it's going to take to, mop the floor here.
Yeah. I mean, an even more probably common example than the qualifying one that I gave earlier is just like, you've got 50 contractors and no employees, and everyone's working 40 hours a week, right? Highly likely those folks are misclassified. There are ways to sort of try and remediate some of this. And that kind of thing gets disclosed, and usually there's a plan kind of gets put, gets agreed upon, and it gets implemented post closing.
Okay.
Yeah, should we close out the stock purchase agreement? So I think that covers some of the major components of there, at least what I'm sort of thinking about. It is common in these term sheets to have the investor get reimbursed for, the vast majority, if not all, of their counsel's fees. And that's just sort of the way that the funds operate. They need to get those expenses covered. But that does normally get negotiated. It's not typically uncapped. And there's a market for that too, depending on jurisdiction.
I've never met a Silicon Valley lawyer that would give me a straight answer to this, but let's have some fun with it. What should these things cost? And you've got two sides. The more you redline it, the more you talk, the worse it gets. But what do you see as a range of the dollar amount for a Series A financing?
Yeah. So I think one reason why you will never get a straight answer from
I don't think you're giving me a
from
number,
a lawyer.
right?
It's not even that. It really, in part, it really depends on the cleanup that's associated with it. And many times these companies have had to appropriately had to allocate their capital, the little capital that they had, to product development and team building, to legal sort of and accounting. And so, we have seen situations, right, where that contractor issue, which I mentioned, happens all the time. Sales tax issue happens sort of all the time. Issues with having, and this is probably near and dear to your heart, running around, cutting a bunch of safes or convertible notes sort of on their own without paying attention to what that pro forma cap table is going to look like, who actually owns what.
It's a lot of work.
It is a lot of work. And so, at the very least, you're in the sort of tens of thousands range in general on the low end. And then, it can go into six figures. It just sort of depends. So that is sort of one reason why, we have seen, and I think you've seen it as well. I think you mentioned it before, right? Today's Series A is kind of like what the B was when you were first raising. And we've seen the implementation and the sort of commoditization of first round financings in the forms of sort of safes and convertible notes, that first money in the door kind of coming in on some of these things, because it is very, very expensive to do a price round.
And Jason, when sometimes I see, like I had a call with a founder today who had raised, I mean, these are real numbers. He raised 3.2, then he raised 4 million, then he raised 8 million, all on safes, all
Okay.
on safes. And I think that some of these guys are afraid of doing a priced round, and or the investors are afraid of doing a price round, not me, because they
Mhm.
think it's going to be too expensive. They don't want to see a high percentage of the financing going to pay K&L Gates and Oric.
Sure.
With what do you how cheaply
So they
can
raised
a
$15
price
million
round?
dollars at this point, right? Is that what you were saying? In the aggregate, they've raised 50.
Yeah, and it was
Yeah.
safe, safe, safe. I mean, you
Yeah.
could have done that first round on a price round and say, hey, this is very clean. We don't have any convertible notes or safes. There's nothing funky and strange here. We just want a straight up vanilla, market standard everything, priced round. I wish you guys had a website I could just fill in the questionnaire
Mm,
and it comes out and we have one meeting and I pay for 1 hour. What's the hourly rate? Like, but that doesn't happen. What's the cheapest you can do a priced round when it's clean, like a seed round? Let's say, he did like 3.4 million. How
yeah.
cheaply can it be done?
I mean, again, it's the cleanup that's the issue more than anything else. So, I mean, I would say you were probably, again, kind of in the tens, low tens to
Okay.
get it done. Not
That
like
sounds
not like
wonderful.
10,000, but like, 20 or 30 is like probably would be at the lowest if it were truly, truly clean. Yeah,
Okay.
truly, truly clean.
And I've seen some recent portfolio companies of mine be upset that I introduced them to the lawyer that charged them 140,000 to complete a priced round. What is the high end of, oh man, we really screwed something up? Like I'm spending too much time on the phone with my lawyer and they're spending too much time on the phone with their lawyers, and it went back and forth and we ended up as the founders paying, the company paying the whole thing. And you could argue that, where did the founder get the money? It was our money, so we paid
Sure.
for it. So, and I don't like doing deals if I don't know the lawyer. So, I like
Yeah.
seeing K&L Gates. I'm like, who is this? Do they know what market standard is? Kind of issue, and that can result in it going back and forth with our market guys. But what have you seen in recent years as high, like almost, you don't want this to happen to you, but I've seen it happen. A lot of back and forth, a lot of cleanup, a lot
Yeah.
of notes and safes, a lot of confusion, cyclical references in the Excel. What's a big number? Like 140 happened to a company of ours in April.
Yeah. I mean, look, that number unfortunately doesn't surprise me. I mean, I've seen that as well. And, I think the issue, there are kind of a couple things that sometimes happen in those deals. I think it can take a lot of time to clean up, right? All this work is very detail oriented work, which means like takes sort of like a lot of time, and there's like a lot of risk, and there are a lot of folks that are sort of stakeholders, right? The company's counsel wants to talk to investors counsel. If you've got sort of co-lead investors, then all of a sudden they're working with like two sets of counsel. You got a lot of cooks in the kitchen, and then you throw in there sometimes trying to if you're moving, deals typically have a cadence. I don't know about what you think about this, Andrew, but I feel like deals sort of typically have a cadence, and there's only sort of so much that you can do to move them any faster. And then once you start trying to exceed that, you can get it done faster, but like it's 20% faster at 50% more cost, basically, to like try and get it done. And so there's sort of diminishing returns on that. But it doesn't, that is definitely a number where you're like, gosh. And yet I've seen it, and I've seen it like, happen with like very reasonable and understanding situations. And so, again, it's kind of why what I sort of see in the market out here is we start thinking about a price round at sort of 5 to 10 million or more in a round. In other parts of the country, it's sort of maybe more 3 to 5. But, on a company side practice, usually thinking like, yeah, that's kind of what we want to see. You want to make sure that if it does cost 100 grand, you're not going to feel like you have spent, 5% of the proceeds or something along those
Right.
lines in the deal.
Right. Yep.
If that makes sense. So, 10 million, $100,000, that's like 1%. You're probably
Yeah,
better
also,
off.
I think that these safes and convertible notes are buy now, pay later anyway, right? I mean, there's going to be time spent to figure them out.
That's right. That's right.
And,
And,
and there's an hourly rate. There's hourly rate for figuring that out.
I mean, buy now, pay later. I sort of think about a little bit like layaway. It's kind of like,
Yeah.
we're going to pay for the legal when we have the money for the legal, so,
Well, yeah. And that's part of running a process, being able to get, a guy like you to give them some valuable advice that can steer them clear of some icebergs before they're ready to, pay your bill.
Yeah. Yeah. So, but the nice thing also is once kind of, if you do the Series A or the Series C, well, that creates a foundation. We haven't really talked about that, but that creates like the foundation for your next round of documents and everything else. And once you kind of hopefully do that cleanup,
right,
rounds are actually, it is an investment. It's an investment in the legal structure of your business and your company so you can scale, the corporate end. So
I 100% agree with that. Yeah. And it's good when people know each other. So the investor who leads this round and introduces you to the next one and says, yep, I did this last one with Jason at K&L Gates. We're ready for you. So I'm mindful of time because I know you've got to jump soon. So what else do we need? Do people must know about this NVCA term sheet?
I think it's grateful. I think it's terrific. They've got a lot of notes in here to help kind of articulate and unpack some of this. I know you've got a lot of resources to help educate entrepreneurs kind of and get used to the jargon and understand these things. I mean, I'd encourage people to check out your other podcasts and material. I know I've also got resources too that help educate the community. I think, each of these, I guess if we were to hit it, 5 main financing documents. We talked about the charter primarily already. We talked about the stock purchase agreement. The investor rights agreement covers registration rights of the securities, not highly negotiated, information rights to the investors, and then some basically
which is terribly important for us. It's terribly important for us. So even get that on a safer convertible note as well.
Right, you got to know your investor. Some of them, yeah.
And pro ratas. We can't jump over that. Why don't you help us understand pro rata equity rights?
Sure. So pro rata rights give the investor or the investors who have them, and they don't always go to all investors. Many times it's just to sort of major investors, but it gives them the right to basically maintain, roughly speaking, their percentage interest in the company in the next round. Gives them the right to buy more preferred in the next round so they can basically maintain their percentage. I say basically, there is some dilution that happens with breathing of the equity incentive plan and some other things, and it depends on how you sort of set the denominators on these things. But that's kind of what it is. It's really critical, especially sort of for those lead investors, and especially for investors who maybe invest in multiple stages, life cycle stages of the company, that they have these rights. And the reason for this is, is it all right if I say, or do you want to talk about it, Andrew? Why is this important?
Well, we typically would not invest into a company if the founder doesn't agree to allow us to invest in the future rounds. And we invest from our fund across a few stages. And by the time it gets to kind of B/C, we're not going to get a multiple that satisfies the whole fund. It would start to pull down the multiple of the whole fund, net of management fees, but we can pull SPVs together. When you were talking about, I like to see at least put 60 days or something on it, I didn't want to interrupt you, but I was thinking I need that if I'm going to do an SPV, and we only email our LPs, and we would only do an SPV for a deal we're already in, and we have information rights. So pro rata equity rights and information rights are, we walk away if we're not getting it. We want to do a lot to help the founder and the team and the company. And we don't want to be told that they're not going to share information with us. Like, we want to hear bad news quickly, not just good news fast and bad news traveling slowly. Now, major investor rights is maybe worth noting for people that it's written down with a specific dollar amount. If you're investing below this amount, you are not considered to have major investor rights. So it's like a flavor of preferred.
Right. Yep. The other thing I would add, or maybe layer in on the pro rata, just maybe to build out some context, and this is what, and you can disagree with me, but sort of part of the venture fund model is, right, building a portfolio and then being able to reinvest in those companies that are doing well as you see that they're actually executing on their business plan and business strategy and hitting their milestones. So it's like it's just part of the strategy. And if you can't take advantage of it, then it's not really fitting into your models. That's why I see it being very important for investors such as yourself.
I think you could also say, I'm going to invest in 25 different startups. So imagine 25 horses, the gun goes off, they're all starting. And there's one that's deep in the lead. And Chris Sacca caught a rocket with Twitter. And he kept getting SPVs into Twitter. And it built into like an institution for him. So if you don't have the right to double down on your winners, that could hurt the execution of the portfolio construction of invest in a basket of companies, help them as much as you can, have information rights. And when you see some doing really well and it all looks reasonable, double down. Go like all chips in, put 10% into your top 5. So now you've got 50% into 5 and 25, 30 of the rest in, highly diversified. And it's not always it's not always going to be 100% all chips in of say 10% of the fund into your winner. If you don't have information rights and pro rata equity rights, it's very hard to execute on that kind of venture. We're diversified, we double down, we have lots of information, lots of communication, and that's theoretically the smart money you're helping.
Exactly. So those are the information rights and the pro rata rights. And they typically major investors will have, as you said, a deeper level of those, they'll have the pro rata rights and they'll have access to greater information, the ability to consult with management of the company. Some of this also gets picked up in the management rights letter, which they might need to get.
Also, if you're in this for more than a decade, you'll find that some of these companies are staying private forever. And yet these big funds are happy just to dump money into them. And, we have a company we've been in for a long time, and they have some very large VCs, and the company doesn't even want to raise money. And the VC said, hey, how about let's just put in 75 million on this valuation? And the company's like, well, we don't really want that money. We don't need it. We've got like 25 of cash or whatever they have in cash, and we're signing customers. And I thought, if you don't have information rights, how would you even know if we want to sell 20, 30% of our position so I can return our fund? On how to manage exits, So these later stage guys are hoping to 2x their $2 billion fund, make 400 million of carry in a short period of time. We've been in it for a long time. If you don't have information rights, you might be good at deploying capital, but you might not be very good at returning capital.
Right. So you're talking about basically secondary sale.
Yeah.
To those other
either
funds.
sell into the round or, either in a case like that, you're selling into the round, In other cases, if you're trying to just like off market when the company is not doing a round, say, you know what, if I can just pick out 3 of my biggies and sell 10% of each on the secondary market, I don't care if I get ROFR'd. I'm literally returning my whole fund in record time and I look like a hero, And if you don't have information rights, that outside secondary buyer who wants to get in the back door of Spotify or whatever, not the front door through a primary because he can't get in, may not agree to a share price, unless you're a phenomenon like, Pinterest. People don't ask questions on that. Whereas for other stuff that they may not have really heard of, but it's a great high growth, late stage company, they want to see the financials,
Right, and those of course can always be tricky.
And the founder,
right?
And by the way, the founder doesn't want their financials going to every goddamn broker dealer in Chicago either.
Right, but no, that's what I was just saying. It can be tricky in navigating sort of all the sets of rights and everything, and making sure, of course, that the buyer has, if you've got inside information, making sure that it's all been disclosed to the buyer, et cetera. But yes, I mean it all fits in the model, right? And that's why it is really important for major investors to have information rights. Something else that we're seeing more frequently, and I do have a call that's coming up in too long. This is maybe a little bit more on an operational level. Certain operation, if there is a board member who is designated by the venture fund or by the syndicate, the Series Seed, let's call them, that director's vote may be required for certain commercial aspects, and that we would see in section 5.5 of the investor rights agreement, and that is included here and negotiated. So things like making loans or advances to subsidiaries or other corporations incurring any indebtedness of the business beyond a certain amount, insider transactions between officers or other employees and the company. And sometimes it's negotiated, except for, travel expenses and sort of other things that are sort of in the ordinary course. Licensing of technology, again, things that don't rise quite to the level of protective provisions, which is what we talked about before. But, one of the reasons why there will be a preferred director is so they can keep their finger on the pulse of the company and be able to sort of weigh in. And these things I find are making their way into the term sheets and into the financing documents more and more frequently. So something to be negotiated, something to be aware of.
Well, listen, we'll make this available in the show notes so people can download this and, read it themselves. And we could keep going. We've kind of touched on ESOP and stuff like that, but I think we should probably call it, since we both are running into the next item.
Yeah, no, it was such a pleasure. It was such a pleasure. I really appreciate it, Andrew.
Jason, listen, it's great. I'll put your contact details in the show notes. Pleasure having you on. I really appreciate you sharing your valuable time with us and going through this stuff. And we could have bored people with another 10 hours of it, but maybe in 6 months or so, we'll pick another topic. Who knows? Maybe we'll talk about pay-to-play provisions when those things are happening.
And there may be quite a few of them. I mean, there already are starting to pop up. So it was a pleasure. Thank you so much, Andrew. I really appreciate it.
Okay. Thanks for sharing your time with us. Thanks. Yeah, bye for now, Jason.
Bye-bye.